119.25, right? Right. It's not 119.25. Okay, it's 119.50. Why? It's so close. I mean, wouldn't it be very upsetting? I mean, the market did stall there. It did happen to stall. That red line happened to be the high of the bearish engulfing pattern. But what if the market got above 119.25 and got to 119.40? Would you want to be out of your short position? No. So this is why we'll have zones. Very often we'll have zones of support and resistance on our service. S1, this would be like, I don't know if this would be R1. This would be like R1 would be a zone if the market had ended today. Our R1, our first resistance area, would be 119.25 to 119.50. And what we do in our newsletter, it's called Illuminations, is we give reasons for support or resistance. So it's a great educational vehicle also. So for example, for our first resistance, we'll have 119.25 to 119.50. We'll say high of bearish engulfing pattern to recent pivot high. Okay, here's a technique I discussed before about setting stops without waiting for the close. Now, we have the shooting star confirming a resistance area. We know that we should wait for the close above the shooting star to say that the market's broken above resistance. But if you waited for the close in that session, look at what happened. Let me show you a little trick to use so you could use an intraday stop. First of all, we define what our price target is. So the shooting star closed at 121.92. Our target, my target, I shouldn't say our target, because yours might be different than mine, is down here around 121.60. So it looks like we're trying to make 28 pips, our potential reward. So our potential reward is 28 pips. Now, let's say we want a 2-to-1 risk, 1-to-2 risk reward. So now we're going to go backwards. We're saying we're looking to make 28. What does that mean? We're willing to risk. Now we're ignoring the bid offer spread. So let's forget. So we're going to go 14. So that means that with the close of the shooting star at 121.92, that's where we initially shorted. So for a 2-to-1 risk reward, it's actually the other way around. Reward risk. It should be 1-to-2. But everybody says risk reward. We're risking 14 basis. So we're risking 14 basis point. So what we're doing is we shorted at 121.92. We add 14 basis point, and this becomes our intraday stop. Anybody want me to go over that again? You see what we've done? We took the profit potential of 28 pips, and we worked backwards, and then we defined what our risk is. Isn't it pretty cool? Yeah. You won't see this anywhere else. This is not in my books. I don't know if I've never seen this before. Anyway, yeah. Yeah.
So would you put in a stop order for just that one day?
Yeah. Yep. The question is, would you put a stop in order for this one day? What do you mean? I'm sorry. The question is, would you put the stop order? Oh, no, intraday. No. The question is, would you put the stop order in for this one day? You'd put the stop order in intraday. It would just be there, stay there. Okay? Right. Right. For those, the ideal stop, I mentioned before that one should place the stop before the trade is initiated. We'll look a little bit more about trading psychology in a couple of minutes, because when we most objective about the market, before we're in the trade, right? The best traders, and unfortunately most of us are not going to be able to do this, don't put in stops. They have mental stops, because they want to be able to pull the trigger on the trade. This is especially for intraday traders. They want to be able to pull the trigger and watch the market. But to be able to do that is a wonderful psychological asset. To be unemotional, say, okay, I'm wrong, get out. Most of us are not going to be able to do it. We're going to second guess ourselves. So for just a blanket statement, always place your stop in before you do the trade. Yes?
Whenever I trade on an intraday basis, sometimes I have experienced a spike by the auto desk. Sometimes I got wiped out, no matter how many, I have leverage on the stop. So usually intraday, I don't set up the stop,
Okay.
but I set up the limits.
Okay. The limit, the entry limit, the buy and sell entry limit?
Yes.
Okay.
So and then once I enter,
And I'll repeat the question. Go ahead.
okay, once I enter in a position and I determine how much I'm going to have a limit, but I didn't put down the stop.
Stop. Okay. And you watch how the market reacts?
Well, and then most of the time I lose.
Okay. Most of the time. All right. What he was saying, what Young was saying is he'll put a trade on, but then he won't have a stop in there. He'll be watching the market, but most of the time he loses. Okay. Nothing wrong with putting a trade on and then saying, okay, I'm going to watch it and see how the market acts to see if I'm going to be out of the trade or not. The advantage of that, again, as market circumstances change, we can adjust our stop. The downside with that is if you don't have a stop beforehand, how do you get your risk reward? You can't. Right? You can't get your risk reward. Even if it's a preliminary stop, I think you should do that because this way at least you're defining your risk. You can change the stop later on, and we'll look at some slides later about adjusting stops. Yes?
I don't think you can have a stop in before you do a trade, but the trade's got to be existing before you put a stop in.
Right.
Otherwise, it's a new position.
Okay, he's saying the trade has to be existing before you put the stop in. But what you do is you set up the reasons for the trade. Bullish and shooting star. Okay? I'm going to sell in the shooting star. The shooting star came before you pull the trigger on selling short on that shooting star. You say, I'm selling the shooting star. My target is here and my risk is here. So you've defined your risk and reward before you put the trade on. And then you put the trade on, and whatever happens, happens. If you get stopped out, you're out.
First, you have to do the trade.
Right, but before you do the trade, you have to define what your stop and your risk is. Right. Definitely.
But actually, what Anthony said is that it is possible to set up the stop before you have any position, because you place an order of the stop level,
Right.
and then you enter the trade. And then
You have to enter the trade first, right. You have to enter the trade first, right. But you should know in your mind what the stop is going to be, yes. Right, right. Yes. I'm sorry, what were you saying?
Don't you calculate the opposite way rather than looking at the target first and see what my stop is? Suppose you have a stronger resistance area,
Right.
higher level charts,
Mm-hmm.
and you see it's close. Like, let's say this.
Oh, yeah, right.
This place is, let's say it is 20 pips away from where we calculated here. So me going to 14 pips stop means I'm asking for cover.
What he's saying is if there's another chart, maybe a higher level chart that has resistance instead of, what did I say, 14 pips higher, 10 pips higher, definitely. You should always look at where support and resistance areas are. And even if you trade intraday, you always have to look at a daily chart. We'll look at an example of this later on. Because if you don't, you're really asking for trouble. And we'll look at this when we get to intraday. Okay. Indicators, the more the better. And this is that grouping of indicators, or confluence of indicators. It could be a group of candlestick signals, one confirming the other, or it could be a candlestick signal confirming a Western signal. And this is one of my trading principles. Okay, the more signals we have joining together, the more likely a reversal. So here we have a hammer and a piercing pattern. But while this is what I call a confluence of candles, a grouping of candles, this would not be a good risk reward. We'd have to wait for a breakout above the resistance area. And I think we saw the slide before. See the hammer? By the time you got the signal. Okay. Here we have a bullish engulfing pattern confirming a hammer.